Most people lose money in the stock market, not because they're dumb, but because they start with the hardest part, picking individual stocks. If you're just starting out, or even if you've tried before and failed, this is how you should actually invest, from beginner to intermediate to pro. Here's how you should invest as a beginner who knows absolutely nothing about stocks and doesn't even want to learn much. And guess what? That's perfectly okay. You don't have to be a financial expert to invest smart. The best way to start is with something called an index ETF. Let me explain. An index is simply a list of top companies, like the S&P 500, which includes the 500 biggest companies in the US, or the MSCI World, which includes global leaders. An ETF, or exchange-traded fund, is something you can buy on any broker that lets you own a piece of that index. So instead of buying one risky stock, you own hundreds of companies at once, like Apple, Microsoft, Amazon, Nestle, Toyota, all in one product. Even Warren Buffett, one of the richest investors in the world, said that for most people,
the best thing to do is to consistently invest in a low-cost S&P 500 index fund.
And he's even instructed that 90% of his own wealth should go into that same index after he dies. Index ETFs are passively managed. That means no expensive managers are picking stocks for you. You're just following the market itself. That also means lower fees, and over time, those savings make a huge difference. Okay, now you're ready to step up. Maybe you want to buy a few individual stocks, but here's where most people go wrong. They buy based on hype, not value. At this level, you need to ask one question: is this stock a good deal? The first thing I look at is the PE ratio, price divided by earnings. It tells you how expensive a stock is based on how much profit it makes. For example, if a company is trading at $100 and earns $5 per share, the PE is 20. That means you're paying $20 for every $1 of profit. But here's the catch. Different industries have different normal PE ranges. Tech stocks often trade at price-to-earnings ratios of 25 to 30, while utility companies usually sit around 12 to 16. So don't compare Apple to a power company. You can also check how fast the company is growing. If earnings are increasing by 20% per year and the PE is still under 20, that might be a good deal. This is how normal people, who aren't analysts, value stocks. They check if the price makes sense based on profit, growth, and whether it looks better than others in the same space. Now let's go pro. Once you've picked a few good candidates, you want to make sure you're not just buying a number, you're buying a real business. One thing I look at is the return on assets. That shows how well a company turns what it owns into profit. A healthy number is usually above 5%. Then there's return on equity. That tells you how efficiently the company uses investor money. A good number here is 15% or higher. But even if the numbers look great, you still need context. That's why you need to go deeper. Who runs the company? Do they own shares themselves, or are they just collecting a salary? What about suppliers, customers, and competitors? Is there something that protects this company from being replaced? This kind of research doesn't take genius-level skill, but it does take effort, and the more work you put in, the more confidence you'll have in your investments. So let's recap. As a beginner, buy a broad index ETF, low risk, low fee, proven over time. As an intermediate, understand what you're paying for. Use PE ratios and compare them by industry. As a pro, go beyond the numbers. Study the business, the people, and the future. See you in the next one.